Hello, anyone here? Testing, testing. Yes, how you doing?
Hello.
Hello. Good to see you.
Good to see you too. Long time.
Fantastic.
It's interesting that we meet in these places.
I'm telling you, this
Mhm.
technology is changing a lot of things. How we interact with one another.
I was actually just laughing with my wife right now that I don't think I ever want to do these physical meetings again because, like today, I have juggled 4 meetings. I have attended
Yes.
my child's closing day, and we actually shared a presentation with my laptop. I've attended two DOTs, and I've tracked this particular event.
Wow. Wow.
So how,
I think it will be difficult to go back to normal. What we used to
exactly.
do. Yes.
This is much more productive.
Yes.
Much more productive. Mm. Hi, David.
Hi, Daudi. How are you?
Hey, David.
Nzuri
Good to
sana.
see you.
I'll be coming to be your customer in a short while.
Please. Hi.
In fact, it's good that
Very well.
we are discussing it now so that you don't bully me before when I come. Eh?
No, as far as you tell you, I don't really actually welcome you beforehand, right?
There's an application which I'm working on right now, which was supposed to come to you on Monday, but it will come maybe tomorrow.
I'm happy to receive it.
For my property fund.
Very good, very good.
I hope to be an issuer.
Now that's music to my ears.
Yeah.
So,
That's what I'm saying. Since I'm going to be prompted on some of it today, I needed to give you that heads up so that
fantastic.
you don't get flawed.
Thank you to Kevin for moderating that session,
I will
as well as
I
our
will
panel.
also not put you
That was a very
under too much
insightful
pressure.
session. Just carrying
But
on
of
the
course, there
discussion
is
around the
pressure from
affordable
the
housing
masses.
and finance.
It's okay. I think
We are going to move straight on to our
pandemic it has also given us an
we
opportunity
will have guests,
especially now that
IFC,
where you're seated
PSRS,
and the opportunities that you have and how capital markets
SC, and
really
also joined us.
start those conversations. And I'm happy that we've made this platform
Welcome to my
start from there.
Thank you so
That's
much
good.
for your.
In fact, I remember I was supposed to come and train your trustees. I don't know if you're in that meeting, the last meeting.
Yes.
Chats about
Real estate.
Yes.
Renee those
guys were not available or something. Yeah?
Oh yes, I remember. I think I had a discussion with
roughly around
Okay.
10 minutes.
Yeah.
So we'll track it later after this. Please, how is Nabo? How has real estate been taking signal?
We are well. We are well. We just moved our headquarters to our houses.
Your discussion was centered around student accommodations.
Haven't we all?
I was telling someone, we spent a lot of time working on BCPs, disaster recovery programs, all those things. But nobody foresaw this. We always imagined that you would be in one location somewhere and you can recreate
the environment. I get you.
But now we have. I get you. It has become the disaster recovery plan. This is the real office.
I get you. Yeah. Well, that's interesting. I'd not even thought of that. That you had not, unless you had deliberately thought that you will not coalesce again. We had always assumed that DR and BCP is we will meet again together.
Somewhere. It was supposed to be somewhere.
Exactly. So especially where we had Mm-hmm.
Yeah.
Like for us, we had infrastructure already set up at Two Rivers. So we have some 14 or
Yes.
15 laptops somewhere, a server
Somewhere,
somewhere,
yes.
just chilling.
Just in case.
I've not even thought of that perspective. What?
Yeah. So I think it's a shift, eh? I think it's been overturned on its head. So maybe now, as employers, we start thinking, should we start paying our employees partly an allowance for home office?
Exactly.
Because literally,
I had to spend a pretty penny on
paying rent for the business.
Exactly. And the ICT data. Hi Gideon, how you doing?
Hi Gideon.
Fine, thank you. Karibu.
Hello, Gideon.
Asante, I've heard you talk of the new BCP, something the world never thought of.
We had never imagined.
I mean, just take it to January, not even January, even beginning of March. If somebody gave a description of the way things are, you would have said, what have you smoked?
Exactly. Exactly.
Yeah.
It was,
I think one of the things we have learned,
yeah.
What people call their worst case scenario. That should always be your best case scenario.
Yeah, that's true. That's true. I agree.
The worst case scenario is always unknown.
Even what we
if you
think,
know something, that can only be a best case scenario.
Yeah, I agree.
Even now, what we may be seeing as the worst may be the best 6 months down the line.
Exactly.
Yeah,
Say it was better in July.
Exactly.
I think when you talk to someone about something that happened between January and February, it sounds like it was 2 years ago.
Hey.
Exactly.
That's how fast things have changed.
In fact,
Adil is not joining us, right?
He should. Why not?
I'm not sure.
No,
who is moderating?
Yeah, he indicated that he is going to have a bit of a challenge. They asked me to step in which case, bad news for you, you'll absorb some of the questions that he had allocated me.
I get you.
Yeah, if that happens. But let me call him.
There's one more gentleman who was to join us. He's called Ngatia.
Yes.
Yeah, Patrick.
Let me also look for Ngatia.
I don't know, he's not been active today.
No, I've talked to him.
Yes.
I've talked to Patrick.
Let me call Adil.
Okay. What has Ngatia said?
No, initially, he was trying to. He was looking for the credentials to log in.
Let
me just. We are waiting for you. Q&A. No, what you do? There's a. Have you seen the link that Patricia? Or is it Priscilla sent? Okay. I think he was in the wrong folder.
Oh, okay.
So I've asked him to just use the link that Priscilla has sent.
Okay.
Ngatia? So have you seen the email that, have you clicked on the email that Priscilla has sent? Correct. Okay. So she should be able to let you in. Yes. Are you there? We were worried. We were wondering where you are, and everyone is already logged in. So, but it's fine. We still have time. Sure.
You.
Welcome. Okay.
Thanks.
Welcome, Gatia.
Asante. Just 1 second.
Hi, Gatia.
Colin. David, how are you?
I'm very fine. I deliberately avoided the other side. You know what I'm talking about.
Yes.
I decided to hide here.
I can understand. No, we're just over here. I thought we could even be enjoying.
Yes.
Did Adil send you the questions that he was to ask you?
Yes, I actually shared with him. Can I share with you?
Yes.
The email.
He confirmed he will not be there.
Okay, let me send you.
Okay. Or did he include me in the calculation?
No, he just sent to me initially an email. Yeah.
Sorry, did I hear that Adil won't be on?
Adil won't be on, so I'm stepping in for him. And now I'll throw all the questions which are located to me, to all of you, and randomly.
Okay. Gideon.
That's very bad news.
Terrible news.
Gideon, can I resend you the questions that we had agreed with Adil? Because there were some of the questions I thought were more suitable for a fund manager.
I saw the one that you wrote to him. There's what he had allocated.
I see what you're trying to do.
You.
No, not what he sent to me. Let me send the other ones. David will understand. I'll send you the other ones right now.
Okay.
There's a problem with.
Okay,
with
I need to know which questions I am answering then.
No, you.
For you.
You, Patrick, you.
Okay.
David, you are.
Let me send you.
I'm sending you just now. I'm actually forwarding you the questions.
Okay. I'm actually trying to just forward, copy to me again. I'm struggling to find them again.
Oh, okay. I think the last one he wrote.
Gideon, I've sent to you now, eh?
Okay, thanks. Let me see.
David.
Yeah.
We
need to get protocol on which David you're talking to.
There are some questions here on trustees. Yeah.
Okay. Yes, I will like send me.
Tuma na WhatsApp.
Sawa.
Hello. Yes, well received.
Kanyi.
Yes.
Thank
Please
you.
share the questions again, tafadhali. I'm trying to find
I will wish you well. Keep safe.
Let me just check.
Bye. Adil has just sent me the question for everyone.
Okay.
I think what was refreshed. So he has, it must be, did he copy you? He didn't copy all of you, but do you want me to forward to all of you, or you are okay?
Please share. Please share. Please share.
Kindly forward.
Okay. I've sent.
Thank you.
So I'm just going to. Just check if you have received. Allow me to attend to something very briefly just before we start.
Okay.
Has anyone received? I haven't personally.
Neither have I. Not yet.
Yeah, I've received now.
You've received, eh? Good.
Correct.
Relief.
Yes.
Good. We have revised questions. We only have 30 minutes. Will you get through all these questions?
We have to be selective, eh?
Yeah, because now we each have 4 plus now we were all to answer the questions for all panelists.
There was supposed to be PS Hinga at 1. I'm looking at the stage, he's not there.
Is it at 1 or at 2?
I heard Fear saying 1. But anyway. I'm just trying to figure out whether this session of ours will get bumped.
I think we are before him.
Okay. Okay.
Yeah.
Okay.
I see most of us have not had a chance to go to the barber.
Not that we've not had a chance, but we cannot dare to go to the barber.
Ngati, I'm looking at you.
Hi everyone, Gideon here from API Events. How's it going?
We're doing good. We'd be happy to see you as well. See if you've gone to the barber.
All right, you guys can get started when you're ready, and then Adil will join a bit later. All right.
So how do we get a signal that we've gone live?
Yeah.
We are live, yes. We are live, and people are starting to come into the room. So you can get started when you're ready.
Okay, thank you.
All right, great. Thanks, guys. Good luck.
Thank you.
Yes. Thank you. We give it 2-3 minutes.
like it's already 1:30. We're officially supposed to start at 1:30.
Good afternoon, everyone. We are happy to host you in this interesting panel, Pension Fund and Institutional Investments in Real Estate. It's something that is attracting a lot of attention. My name is Gideon Choka. I will be moderating this panel, and with me in the team, a very distinguished professional. I'll start with the introduction of Mr. David Kanyi. Mr. David Kanyi, he holds a position of Team Leader Market Development at the Market Deepening at Capital Markets Authority. He has 15 years experience, having joined the authority in February 2008. And immediately prior to this, in July 2019, he was the head of price and market surveillance and derivative at the authority. Prior to joining the authority, he worked at the exchange between 2004-2008 in both trading and internal audit departments. Quite a rich experience. His current responsibilities include market deepening by facilitating, among others, uptake of existing and new products and services, and driving innovation through designing, developing, and implementing policies, procedures, methodologies, and quality standards to support introduction of new products, services, and innovations into the capital market. It's responsible for driving stakeholders' engagement to increase uptake and design of new products based on established needs. He's a graduate of the University of Nairobi School of Business with a Bachelor of Commerce degree specializing in finance. He's a full member of the Institute of Certified Investment and Financial Analysts and the Kenya Institute of Management. He's been pivotal in the development of derivatives in Kenya, including providing guidance and quality assurance to the various teams and market stakeholders through the process. He has served in various capital forums, including the East African Community Market Integration Initiative, Bond Market Steering Committee, Capital Markets Authority Master Plan Implementation Working Group Champion, among others. When he's off work, he loves soccer and golf, and this environment, he must be really wishing that COVID can be behind him so that he can get started with this hobby. Now, next, I would like to introduce the other David in the panel, Mr. David Luigi. He is the Property Investment Manager at Gen Africa Asset Managers. He was appointed an investment manager in 2014. His responsibility and focus is on property, asset class, where he starts with research and development, and is providing support and advisory for investments in real estate and overall product development of this vital asset class. Prior to that, he worked at NW Real Light Limited as a property portfolio manager. David has 9 years experience in the real estate sector, and he holds a Bachelor of Arts degree in Land Economics honors from the University of Nairobi. He also holds a diploma from the Institute of Surveyors of Kenya as a full member, and is a registered valuer under the Valuers Act with the Valuers Registration Board. Then I move to Mr. Pius Muchiri, is the CEO of Nabo Capital. Pius is the founding CEO of Nabo Capital, and his passion is to connect investors to the lucrative opportunities across the region in Africa. He is passionate about investors, and he cannot afford to ignore this continent. He is really driving that theme, and the key topic when he speaks to global investors is that Africa is not a continent to be ignored. He is quick to acknowledge that he has the best job in the world. He believes Africa is the best place for investment for anyone who is wishing to make a remarkable difference and to leave a legacy. And that is what he wants to do. He has more than 13 years experience of successfully investing in Africa. He has overseen investment transactions in excess of $500 million. And on the back of this remarkable success, he's led his team at Centum to spin off into an independent, fully fledged investment boutique, which is now known as Nabo Capital, and is currently managing assets worth $210 million in assets under management. He's helped reputable institutions institutional clients from US, Europe, Asia, and Africa to acquire sizable stakes and break into top 10 shareholders list of some of the most coveted blue chip companies that we have in the continent. He leverages a wide network with unique boots on the ground experience and operates across multiple asset classes such as equities, fixed income, private debt, private equity, and real estate. Pius was part of the dream team that formulated and successfully implemented the now famous Centum 2.0 strategy that began the exciting journey of transforming Centum, which was once laid back to a 60 million investment firm into 1.8 billion fund assets under management outfit. Pius is a CFA charter holder, a certified public accountant, and holds a bachelor's degree in commerce. The last but not least is Mr. Ngatia Kirunje, Director, Spearhead Africa. Mr. Ngatia is the founder of Spearhead Africa, a Nairobi-based property and infrastructure advisory business, and head of the Kenya Pension Fund Consortium, KEPFIC Secretariat. KPFIC is a consortium of local pension funds with approximately $2 billion in assets who have come together to jointly assess and invest in housing and infrastructure opportunities in the East Africa region. Mr. Ngatia is responsible for investment screening and engagement with institutional investors, including members who are not part of the KPFIC, project sponsors, government, policy makers, and external stakeholders. Mr. Ngatia has extensive experience from a large financial institutions in New York, London, and Nairobi, and leads Spearhead Africa's project, structuring efforts, developing initiatives and bespoke financing structures and capital solutions to meet client project requirements. He is also responsible for developing the firm's investment capital network with local and international commercial and development banks, insurance companies, pension funds, and asset managers. You'll agree with me, the audience, that we have a very rich panelist, broad experience, and we look forward to having a lively session with you. So we jump into the panel discussion. I'll start with Mr. Ngatia. Not everyone here has heard of KEPFIC, but I'm sure that we all will be interested to know more. Would you like to take this opportunity to tell us a bit more about it?
Thank you, Gideon. Maybe to make it a bit simpler, we can just pronounce the Kenya Pension Fund Investment Consortium as KEPFIC, which is a consortium of prominent Kenyan pension funds who have come together for the purpose of collaborating to make sustainable long-term infrastructure and alternative investments in the region. As a consortium, we aim to mobilize and invest approximately $250 million over the next 5 years into our infrastructure needs as a country. That is $250 million may seem like a lot, but not when compared to the country's infrastructure gap, which right now stands closer to $40 billion. So our aim is to build the technical and investment capacity of our member funds to help provide competitive returns and diversification opportunities. And we will do this not only by the pooling of the funds for the infrastructure investment, as I mentioned, but also by attracting co-investment from other domestic investors, including insurance companies, as well as foreign investors. The Retirement Benefits Authority, which is our regulator, recently included infrastructure as a distinct investment asset class, which will now allow pension funds to invest up to 10% of their assets into infrastructure. And this really will unlock approximately $1 billion to be invested into this category. This is really important right now at a time when not just our government, but governments all over are facing a lot of fiscal pressure. We have seen budget deficits are widening, and this is a time when governments have competing needs, primarily right now healthcare. KEPFIC was recognized as the Pension Fund Infrastructure Initiative of the Year in 2019 under the Africa Investor Awards. And we have received significant support from the World Bank, from USAID and their implementing partners here in Nairobi, Palladium. And we're working very closely with government through the PPP unit to identify suitable investment opportunities and help assess the project bankability, as well as engaging with one of my fellow panelists, David Kanyi, at the Capital Markets Authority to develop a support framework for pension fund infrastructure investments via listed capital market instruments. Thank you.
Thank you. Let me then jump to Mr. Pius. Pius, you have significant experience with international investors who look to invest across Africa. With respect to property in particular, how do you compare an approach of an international investor to a local one? We can't hear you.
Unmute.
You're on mute?
Can you hear me now?
Yes, we can hear you.
I think if you followed me for some time, you notice I always say invest like a mzungu, meaning invest like foreigners. But I was just looking at the data today, and I noticed that it is quite mixed. Foreign investors investing in the real estate space here tend to go both direct and indirect, but with a significant bias towards direct. And there are a couple of reasons for that. Number one is the scale, availability of large ticket transactions. If you want to invest $100 million today, which in this market is a sizable amount in capital, but not significant if in a European setting or in an American setting, there are very few assets that you can actually deploy to that can absorb $100 million at one go. So the pattern that I tend to see, large ticket foreign investors tend to go direct. If you look at Actis, you look at Rendezvous, you look at Avic, the guys who are investing GTC on Chiromo, all of those guys have gone direct. But if you look at the ticket sizes, they're all well above, $100 million. So they tend to then have to create opportunities for themselves. If you look at foreign investors who are investing small to mid-size ticket transactions, they tend to then go through indirect. An example is the Old Mutual Property that invested, 50% stake in the Two Rivers Mall with Centum, the Centum Group. You look at Shapoorji, who have partnered with Actis, and they're investing in the housing sector. So they have gone indirect, whereby they have core investors, or they are core investors in the space here. Something else that really jumps at me is that the kind of foreign investors in the real estate space that we are able to attract today are primarily specialized investors in the real estate space. It's quite a unique space because it requires a bit of control for you to be in charge of the value creation agenda. And given that there is not a lot that is available to invest indirectly, we are still at infant stage when it comes to rates. There are not many funds that are out there, real estate funds. I've had David is working on a real estate fund. There are not many opportunities that are of sizable scale to absorb the kind of capital flow that we can attract from foreign investors. So real estate, to me, if I may just conclude this piece, is it's still very opaque and not very well organized. to attract a consistent flow of capital. And that's why we are only attracting just a very small fraction of the very, very specialized foreign investors in real estate.
Thank you. Let me turn to Mr. David Luigi. David, you drive the property side of investment management business at Gen Africa, and you have also launched recently the Bashan Fund. What can you tell us about the appetite for property for property investment from a fund management perspective to local investors? And I know most of the uptake is in the pension sector.
Thank you, Gideon. Good afternoon, ladies and gentlemen who are participating in this session. I think for me, my perspective looking at our journey as Gen Africa in managing institutional funds and more so in the real estate sector, the appetite is pretty good. We've seen that capital markets in real estate, and more so alternatives to include private equity as well, have been quite good, especially that on the basis for pension schemes, that they are currently over-invested or overly concentrated on your traditional assets. And with the volatilities on those traditional assets, like the stock market taking a beating because of everything that happens in the market now, COVID, which has affected all sectors, interest rates, volatilities on your bonds, gives a challenge to fund managers and pension fund members, because they have to mark to market on an annual basis, and especially for calculation of exit values as people retire on an ongoing basis. The problem, notwithstanding that appetite, the problem we've seen with the uptick on real estate products on the capital markets is in the structure and also in the risk-adjusted competitiveness of these real estate products when compared to the instruments on the traditional side. So you'll find that even foreigners, like Pius has mentioned, see a route to market on the Kenyan real estate because it has been quite stellar in its performance, notwithstanding we are now seeing a correction on that side. But capital markets is unable to structure a product that on a risk-adjusted basis is able to really solve that need. And I think without preempting the discussion, I could probably say that the main reasons why some of these real estate products are uncompetitive are not in and of themselves, but the environment. So when you look at risk-free rates in this market of ours, capital markets, they're quite high, probably outcompeting your typical yield producing real estate asset. Somebody has also already mentioned about how opaque our real estate markets are. And the more critical element is real estate markets, the underlying assets are by nature very illiquid. And therefore, what impact that has on the liquidity of real estate products on the capital markets end is something which I hope some researcher will give us what the percolating effects are. I think I'll close it at that. Thanks.
Thank you so much. May I turn now to Mr. Kanyi. Mr. Kanyi, what level of activity are you seeing in terms of registration of new investment vehicles at the Capital Markets Authority?
Thank you, Gideon, and thank you everyone who is joining us to listen to this very informative and very technical, I would say, panel. Now, first of all, I would start by saying, of course, as capital markets, we provide channels for savings into investments in projects for economic development. Of course, we are alive to the fact that markets move, markets are very dynamic, and we've tried to provide that alternative source for long-term finance for long-term productive investments. We continue to see what we'd call a COVID innovation sort of products and services coming on board. I think the last 3 months have been a very busy period for us here at the CMA, just trying to support our intermediaries, support the markets, the investors, and support the issuers who are coming up with, I would say, very innovative products, akin with the times that we are living in. Of course, with the new normal, it calls for innovation, and it calls for us to look at how do we digitize our processes, how do we tap into the fintech space, and this has, of course, brought up new products and services. So we've seen a lot of new applications specialized for collective investment schemes, especially the ones that deal with the home ownership schemes, which are traditionally seen as very attractive to support the Big Four agenda on housing, and also supportive in terms of tax benefits that they bring on board. So we've seen a lot of applications in that area. We've seen a lot of upsurge in use of new sort of setups in terms of companies that come to us in the form of an LLP agreement, as opposed to limited liability companies by to create special purpose vehicles that are now used to of course deliver some sort of new products into the market. We've also seen very specialized schemes, from the plain vanilla money market funds, but schemes that are trying to tap into the alternative space. I think Pius is one of persons who's kept on knocking our doors with diaspora sort of dollar-denominated schemes, or schemes that are typically moving away from the plain vanilla traditional aspects of investments in money markets, in bond funds and all that. Now, in terms of also participation by new sort of, would say, fund managers regionally, and also fund managers, coming out of other jurisdictions, just to look at how do we then realign the new structures on fund management schemes, where we have seen now companies coming in as promoters of some of these schemes to tap into the market space, where probably traditionally has been a preserve of fund managers. So as we look at the new normal, we're also looking at how do we facilitate as a regulator to onboard new ideas, to onboard especially innovative ideas, which are transformative and also lead to economic development.
Thank you. I notice we don't have much time left, but very interesting. I'll go back to Pius. Pius, what are the key factors that drive decisions of international investors, and are they, even with the changes we are seeing, are they continuing to show appetite for affordable housing investments?
Thank you, Gideon, for that question. And I think we have to look at the environment where they are coming from. Remember, for someone who is based in the US or based in Europe, for them to send their dollar to the continent, this is perceived as a high risk market among the frontier space. They've got to ask themselves, why do I have to send my dollar out there? And one of the things that is strongly driving investors to come here to look for opportunities like in the real estate is the fact that today we are in a very interesting time where they are faced with zero interest rate or negative interest rate. So globally, there is a lot of liquidity that is chasing for yield. So rental yield is at the top of their mind, and this is probably one of the areas where they have a different mindset compared to the locals. The locals have had a mindset of quick capital gains with an exit in mind at some point. So the foreign investors tend to look at the rental yield, and The rental yields, of course, have been coming off for quite some time. And as David Luigi mentioned, one of the challenges that we're facing, of course, is the fact that we have very highly, or rather very competitive sovereign yields, but all in the specialized foreign capital that is looking for real estate. The number one thing that they're looking for is rental yield. The second thing that they tend to look for is, of course, safety. I mean, you can imagine, even us here locally, we are 43 tribes. I will highly doubt that David Kanye has a lot of land invested, a lot of property investments in Western Kenya. And we can talk about that about ourselves. So property investment has something about proximity. And therefore, people tend to think anything to do with real estate is tangible. I want to see it. I want to wake up in the morning, I can point at it and say that property is mine. But when you're very many miles away, then questions around safety, is my money going to be safe, really become important. What are the regulations that support foreign investments here? The judicial system. If I have an issue with my investments or with my partners, how can those issues be resolved? Is my money safe at the bottom line? And the third thing that is very, very key, and I've mentioned it, again, I think it will keep appearing, is scale. Can I deploy sizable capital one time without distorting the market? That is another very important thing, and therefore, that's why some of them are, at the moment, because there is not enough offering from a securitization point of view, they tend to create the opportunity for themselves by going direct. The other thing I can put here that is very key for them is local presence. If they don't have strong local presence, then they go for strong local partners. And they are, the players here like Actis, Centum, and some of the insurance companies have been very key in attracting foreign capital here because they are, trustworthy brands. They've been there for 50 years plus. They have a proven track record of dealing with multinational money. So that is very, very key for them to know that there is somebody here who is constantly watching over their assets. And probably the last factor, because there are many, I need to limit myself. The last one is really impact. Something that is constantly now, becoming a strong emerging trend. Impact, ESG. There's a lot of hype around green investing. So the foreign capital tends to come from a very rich source, and therefore they're not just looking for return, but they're also looking for, what can I say beyond making money? I left the place better. So if you can be able to demonstrate that you're paying attention to ESG factors, you're paying attention to climate and everything else that comes with the well-being of the general humanity, then it's a real strong plus. So new theme to tick most of these boxes because the rental yield is potentially high, with the right partners and regulations in place, then safety is there. Scale, it can also be scaled, especially with the Big Four agenda that the government is pushing. There's a lot of opportunity to scale it up, and of course there are strong players, local players who have put in their capital there. So affordable housing is something that is looking like could be packaged together to be palatable for foreign capital.
Thank you. I'll move to Mr. Luigi, and you can roll out a number of these concerns, these questions, and give us some insights into some of the challenges that you face from investors and how you've addressed them. Also, seeing that you're on the ground and offering direct property investment, how do you find the regulatory environment? Is it favorable? And what role does regulation have in terms of property investment and structures, as well as for affordable housing? You can roll up that before we go to the round winding up question. David?
Thank you, Gideon. When you look at the three issues you've raised, some of the challenges that we've faced from investors and what we actually see as the role of regulation and how it is in Kenya, and especially how it should support some of the initiatives, especially in affordable housing. We think that other than just the structural inefficiencies in our capital markets, like we've discussed, the very competitive risk-free rates make it quite difficult for capital to be attracted to other asset classes. But that notwithstanding, regulation has a role that, yes, the customer is looking, or the investor is looking for returns. And so investor protection, so that they can at least protect their initial investment, becomes the first role of regulation. The second role, and I need to be careful with my words since my regulator is in this panel. The second role that regulation needs to do, and this is where I'd want to challenge our current regulation frameworks, is to enable the businesses and issuers, so that if an issuer or a developer wants to now come to the third role of driving capital towards various strategic initiatives such as affordable housing, then regulations should not make it difficult. They should actually be an enabler. So in my experience in trying to come up with Batian Property Fund, is that our environment is like a game of chess. You have your customer or the investor, he has his own risk and return requirements. You have the rule of the law, which David Kanye here is the custodian. He's provided for you with all the rules, the do's and the don'ts. Then you have your business and your shareholders, and they're telling you, it has to be viable and it has to be sustainable. So the role of regulation should be to enable and to help us as we innovate to balance this out. So the challenge which I have seen with the Kenyan space is, I think we've been too much leaning towards investor protection role, and it has made the business enabler role take a beating. And if anything was to go by observation, you'd look at the number of issues post Safaricom IPO in 2008. I think the next issue was the Fahari Stanley IRIT. So that speaks to the role of regulation as a business enabler, or for market deepening, needs to be a bit more flexible. And I'm happy to hear my fellow panelist, David Kanye, saying that they are now, as the Capital Markets Authority, being more responsive with these new innovative structures like the limited liability partnerships and other ventures that are coming together to actually try and solve investor problems and drive market deepening. So we believe that if that happens, then we can be able to drive scale, a key requirement for solving investor problems such as affordable housing or restructuring portfolios within this environment. Thank you.
Thank you so much. In about, Mr. Ngatia, in about 30 seconds, KEPFIC is focused on infrastructure. What are the tie linkages with housing, especially affordable, and where does affordable housing fit in the agenda for pension schemes? In about 30 seconds.
Sure. Maybe I can start with where does affordable housing fit in the agenda for pension schemes, which leads to the next question. I think pension schemes can play a role in both the demand and supply side of affordable housing. On the supply side, we all know pension funds are the holders of a lot of land, which can be used for joint venture partnerships with other developers. They can also be developers in their own right. On the demand side, they can play a major role in end user finance. And this is because of the long-term nature of their liabilities, the pension fund liabilities. So they can be a potential offtake to developers who need to recycle their capital as quickly as possible and could potentially offer tenant purchase schemes, which are rent to own. We also know that pension funds can also be a new source of capital for buyers. Recent regulatory changes now allow pension members to access up to 40% of their pension savings for a home. But to your question on where is the tie-in affordable housing, I think the primary linkage is on the infrastructure requirements for, let's call it a particular affordable housing project. I think there's an opportunity for tie-ins with developers where pension funds, where KEPFIC as a consortium invests into a project and covers the internal infrastructure component of that project. So the water, the power, let's call it even the data services. Then KEPFIC would then work with a project-specific utility company that offers those services to the residents. And we are then repaid by the users or the residents over a 10 to 15-year period. We've seen this project utility model work before, but it's typically been applied on large-scale developments like Two Rivers and Tatu City, but we believe there's an opportunity to do the same on a smaller scale. So essentially, by covering the infrastructure portion of a project, and let's call that 15% of the total project cost, the developer's contribution is lower, and as a result, the developer can offer these affordable housing units at a lower price, as they have less capital outlay to recover. And at the same time, KEPFIC will create a long-term cash-generating asset. We are lucky we can do this because we have the patient capital that can be deployed over 15, 20 years. Thank you.
Thank you. Mr. Pius, in 20 seconds or so, in your view and in context of global rates, collective investment project, do you think this needs to happen to spur growth and uptake in this area? Pius?
Sorry, Gideon. The line was not very clear, if you don't mind.
Let me just repeat. Can you, did you hear the question?
No, I didn't get, it was on and off.
Okay,
on
I
my
was
end.
saying, I was asking in your view and in context of global experience of rates, collective investment, structured products, etc., what do you think needs to happen to spark growth and uptake in these areas? In about 20 seconds as we wind up.
Yeah, I think for me, and I've spent a lot of time thinking about this because it's very clear that the future of our real estate lies in products like real estate investment trust, or rather indirect investment. And we have attempted a couple of times to bring that to the market. We cannot call ourselves successful yet. The more I think about it, I think it has something to do with regulations. We have a culture of ownership, and people, institutions and individuals will invest in real estate directly, regardless of how inefficient it is to allocate capital in that fashion. And therefore, I personally believe that the secret lies in the regulations. Just the same way we've used regulations to promote retirement. I think now that might be a very good tool to push or to make the pension, especially insurance sector, to invest in real estate or in property market through indirect vehicles. and there are specific benefits that are important here, and one at the top of them is really enhanced liquidity. If you look at these two sectors, which are the biggest holders of real estate in this market, and therefore their balance sheets can tend to be illiquid to the extent that they're holding these properties, the biggest thing that they really need is liquidity. And collective investment vehicles would be a very powerful vehicle to ensure that they have liquidity in their balance sheets. We're already seeing the insurance sector, the regulator pushing for more liquidity by imposing punitive haircuts on property investments. But I think if we can have an offering, large ticket offering in collective investment vehicles combined with the regulations, I think we could create ourselves a much needed real estate market that is indirect.
Thank you. David, finally, Sakanyi, a lot has been touched on, but what are the recent updates to regulations you can share with us? And what are the new requirements to register? What about the new requirements to register PE funds with the CMA? And what is the thinking behind this? And what impact do you expect? If you can condense it in about 30 seconds.
Thank you. That's heavy, but I'll try, Gideon. Now, in terms of regulation, I think my fellow panelists have really touched on regulation, and I think that this has been a challenge over the years, and we are cognizant of the fact that for you to have a market developed, then you have to have robust regulatory framework. Now, to assist in this, of course, we have to ensure that we have a facilitative and enabling environment with regulations that speak to the investors, and so that can also be uptaken by the investors for utilization. We have undertaken to overhaul some of the regulations that we've had for some time, especially the public offers. I know Luigi mentioned about the public offers and listing regulations, trying to ensure that we speak to the current environment and current demand that is being driven by the users or the issuers of these securities. We're also looking at how do we also benefit from fintechs and the utilization of some of these platforms within our very limited regulations. So we've created, of course, a sort of a sandbox, which is a trial area where we allow new innovations to come in and be tried out, to a limited number of people. Then, if they're successful, then they can be rolled out to the mass market. And especially when it comes to crowdfunding, which has become one of the key hot points where we are seeing a lot of interest, from away from the traditional IPOs or traditional issuances. Also, in terms of trying to also accommodate the new asset classes within a CIS recognized infrastructure, I think we have been using, of course, a CIS regulation that has been there for some time. So there is also a work going on trying to overhaul that CIS regulations and expand our Section 78 that provides for all asset classes and the limitations within there. And I think this will also speak to new products that we are seeing every other time being brought to us in terms of seeking for waivers or exemptions. And I think this speaks to the new ways of doing business. In terms of, and I think also to speak to that, new ideas like akin to what KEPFIC is trying to do, the consortium. We are happy to listen and also on board this so that we can assist these funds have a housing somewhere where they can also assist in economic development. So we welcome all those new ideas, and also and we can facilitate that process. In terms of the PE funds, and I think this was just as a way of background, this was pronounced in the recent Finance Act 2020, which amended the Capital Markets Act to allow for regulation of private equity funds. And of course, what follows next is we are trying to bring up what we call a collaborative regulatory framework with the likes of EAVCA, that is EAFCA, to bring up a light touch regulation akin to what we have in the CIS, where we allow the funds that would want to tap into public funds or the PE funds that private equity funds that would want to tap into the public funds, then come under a certain form of regulation, and this is to provide a framework to allow for that kind of access. I think it is beneficial to both, of course, the PE funds and also the pension funds, because some of the pension funds are very risk averse in terms of allowing certain thresholds to be passed in terms of PE funds utilization. I think with a formal regulation, then that provides some comfort to the pension funds or pension schemes to allow those alternative investments to be tapped into, and also tap into those returns that have been elusive for a very long time. I know David has always been saying that we push investments to government paper because it's an easier way out. But I think there are other areas where we can also facilitate market players to also utilize alternative investments to also get that return. Also, without losing the importance of PE funds, of course, PE funds are also very important in developing SMEs and SME space. And we think that with this kind of regulation, we also bring in that kind of mix and balance, and trying to see also how we assist our SME market, and also ensure that private equity funds are also able to tap into this in a regulated way. Thank you.
Thank you so much. So I think just one question to wind up. Pension schemes, this is for all. Anyone can take it. Pension schemes have traditionally been invested.
We've lost Gideon. You
Hi.
can hear me, Ngatia, and you can hear me, David?
I can hear you.
We can hear him.
Can you hear me?
I can hear Gideon.
Yeah. Luigi, can you hear me?
Oh, I can't hear you.
Yes, I can hear you. I can hear
I've
you.
lost it.
Pius, we can hear you very well. I think there's a challenge from your end. So pension funds have traditionally been investing in direct property. What are we seeing in terms of the appetite for indirect investments? And if there's one reason you would give that hold trustees back from investing through alternative investment, would you share what holds them back? And finally, also we can roll it all. What do you see as evolving property market trend post COVID-19? And how is this going to hurt or help the cause for pooled or indirect funds? So you could take a piece, maybe a chapter. I start your final round. Mr. Luigi, do you want to have a go?
So I can go first. So pension schemes have traditionally been going into direct property because, like I said, there has been a dearth of capital markets products by way of real estate, the real estate asset class. When you look at the experience that has been for those who have dabbled in direct real estate, I am looking for the best adjective that will be politically correct, but I can say that we have seen horror stories from pension schemes who have gotten into the muck of trying to become construction project managers or property managers. And this is essentially the reason why we created the property fund known as Batian, because I can sum it up into two things. One, let the experts do their job. When I go to the airport, I let the pilot fly the plane. I do not think that because KQ is not doing a good job of hiring pilots, I go to Wilson and learn how to fly a plane. Even if I knew, I'd just fly my plane. I'd not go and try and fly a commercial jet. So when trustees attempt to do what Aecon is doing, those guys have been doing it for the last 20 years, and they still don't get it right 100% of the time. Let the experts do their job. So I'll sum it up into two words: strategy and execution. Where trustees think they know what real estate investment strategy is, they need to be very careful that they indeed do know. And then in their execution of the same, they need to be sure that, I don't know where that echo is coming from. They need to be sure that they know all the checkboxes that they need to tick to ensure that a very good strategy is not bungled up by poor execution. So direct real estate is wrought with risk, and that is what we are trying to help trustees and pension scheme investors to get away from direct investments. And in the COVID environment, what this has taught us is diversify, diversify, diversify. For you to be able to diversify, you need to have scale enough for you to diversify. So why don't we pull together so that we can diversify? Then when a sector or several sectors are hit by a black swan event such as the COVID pandemic, there are some sectors which are probably more resilient, essential services, that at least everyone has a piece of the pie. But if you're 100% concentrated in sectors that have been decimated by this pandemic, then 100% of your real estate investment is gone with the wind. So post-COVID, go indirect so that you achieve scale to diversify and let the experts do their job, strategy and execution. Thank you.
Thank you. Very well said. Mr. Ngatia, the final remarks.
Thank you, Gideon. I think I'll just add to what David is saying, and it's probably along the same lines. One of the key concerns that hold back trustees from investing through alternative vehicles is primarily, I would say, the track record of the manager, and maybe that's my way of saying there are not very many managers out there that do have long track record. And what that does is it leads to a kind of I can do this myself viewpoint or mentality from the trustees themselves. So just to add to what David has said, it's important that the fund managers show, number one, their track record and show why they can do it better than the trustees, specifically when you're looking at property assets that individually have been undertaken by the trustees as individuals. So housing is one of them. But when you look at something that's a little bit more specialized, say warehousing or other kinds of industrial property assets, then I think there's a little bit more flexibility, or there's a little bit more openness from these trustees to actually place their money with a manager through an alternative vehicle.
Thank you so much. Mr. Kanyi, your final remarks?
No, thank you, Gideon. I think one of the biggest challenges you've seen with trustees is mainly skills and also understanding of the products available in the market. I think in the very many forums that we've held with trustees, they get shocked by the array of products that we indicate to them are available for their, but they're only skewed towards only buying property, government paper. But there are many other products where they can get exposure, not necessarily, just putting all their funds in buildings and all that, but also getting exposure in certain asset classes that would give them a return akin to the same. And I think when we look at the tenure of trustees, also it competes with the long-term nature in terms of returns of some of the projects that they get into. So there's a tricky balance between for them appreciating the returns in capital markets are long-term in nature, and also ensuring that you're also investing pension funds that are long-term in nature in terms of utilization. Now, in terms of offering some of those products, I think we have been very keen to also provide various arrays of products so that you don't only also over-concentrate in investing these funds or these pension funds into only very limited assets. We have green bonds, and I think those are some of the products that we've seen that have been taken up by pensions. We have, we want to look at green REITs, where they can get exposure to real estate investment trusts that also only track, of course, projects that are certified as green. We have Islamic REITs.
Welcome back to our audience. Thank you for waiting patiently. We just had some technical issues, but we are very fortunate and very honored to have the PS with us
Well, I think
here
our
today.
session
So
is
I'd love
over.
to formally welcome the Principal Secretary, Charles Inga Wara, from the State Department of Housing and Urban Development. Yes, thank you so much for joining us and giving us of your time. Obviously, we'd naturally want to be in Nairobi.
David, I think we are done.
To you and let you take on for the proceedings.